legislature can wave its magic wand and insurance rates will go down 50%, probably are not realistic. I think there are a series of short-term solutions that have to be put in place, and I think there are a series of structural changes in the insurance market that have to be put in place, with ultimately the hope that this regulated, subsidized, and government-involved industry can, in some sense, accept some public responsibilities and not just fulfill a private purpose.
Well, I'll start. The series of short-term solutions and the structural changes, what are they?
I'll talk about one
Sure.
specific and what Senator Gates had in. The CAP fund, we will see changes. The House and Senate have agreed that there should be changes in the CAP fund. And to explain what that means is that right now under current law, whenever there's $6 billion worth of damages or more, the CAP fund will kick in and it's money available, excuse me, money available to bond for the reinsurance and for insurance companies, and it's kind of a shared risk philosophy. It was created after Hurricane Opal. The House, in our bill that we will take up this week, lowers that from $6 billion to $2 billion, and it goes from $2 billion to $20 billion in the coverage that the state will share the risk with private insurers. Well, what that does is it creates more of a stable market for the private insurance companies to come in to Florida and write insurance, and so it kind of helps offset the risk, which hopefully means a rate reduction. The Senate is at from a $6 billion to a $3 billion, and from $3 billion to $28 billion that the CAP fund will have a role in playing. So the private insurers, and again, that's ultimately what our goal is to create competition, to create a stable market. And as Don said, that this is a role that government is to play, and I agree with everything he said about my philosophy as well. Long term, my philosophy is to see the state get out of the insurance business and create a competitive market, but that's unrealistic to think that that's all we can do this week in Tallahassee. So there is a shared risk, there is a shared responsibility with the state government as well as private insurers, and that's very difficult to say. But after spending hours and hours of meetings and going through all the different proposals, to get this whole industry and the crisis that we're in under control, I think by lowering what I call the threshold of the CAP fund will help bring some stability and hopefully reduce rates. And any savings in any kind of reduction of rates, both the Senate and the House have in our legislation, those savings go to the consumer, to the property owner itself, not to the insurance company or not to Citizens Insurance. But any savings that we see in any legislation that we pass, in particular in the CAP fund, those savings will be passed down to the consumer, which will mean a rate reduction.
And that's one of the differences between what the insurance industry is proposing and what both the House and the Senate insurance committees and leadership are proposing. I think that the insurance industry would like to see savings go into the big insurance industry pot with the hope and faith and belief that it will trickle down to individual policyholders. I don't think that we can, I believe with Ronald Reagan, trust but verify. I think we have to make sure that any savings, whether it is as a result of reconstructing the CAP fund or mitigation or any of the other things that Ray and I can talk about and that you know about, that any of those savings drop directly into reductions in premiums paid. Otherwise, this will be simply an exercise in legislating, and it won't have any direct benefit to people who pay for property insurance. Those of us who don't live in the insurance industry may not understand this whole thing about reinsurance, and I'm not going to try to give you a seminar on it because I don't understand it as well as I should, but here's a way to think about it. There are models that are created by scientists and econometrists, econometric models as well as scientific models, which are used to predict the costs and implications of various kinds of storms. And there's a whole debate about those models. There are 4 models that are used, and then there's a public model which will come online in April. So there ultimately will be 5 models used. But the point as far as reinsurance is this. Insurance companies, just like banks, aren't the only participant in the actuarial process. When you go to the bank and you deposit $500, the bank doesn't hold on to your $500 in that you might come back someday to get it. The bank instead lends it out. When you go to the bank to borrow $200,000 for a home mortgage, that $200,000 doesn't come out of the vault in the back of the bank. Instead, the bank may take $50,000 of that $200,000 out of their assets, and they may sell or participate with another bank, a correspondent bank, in $150,000. Or they may take the whole $200,000. But it's often the case that there's somebody who's a rebanker, to coin a phrase. Well, reinsurance works the same way. Whether it's State Farm or Allstate or anybody else, what they do is they lay off a good share of their risk on reinsurers. Well, the reinsurers are not people who live in Okaloosa County or in Florida. In many cases, they don't live in this country. Instead, reinsurers are often in Bermuda or Hong Kong or Singapore or Tokyo or London. The same people who hold our national debt tend to be reinsurers. The reinsurers look at the Florida market as business people. They, as Teddy Roosevelt said, they have no soul to damn and no body to kick. They look at it strictly as a business enterprise, and they see Florida as a place that's had all this damage and all these storms in 2004 and 2005. So the cost of reinsurance is extraordinary, and that cost then is passed along by the insurance company to the policyholder. Well, here's where the CAT fund comes in. The models suggest that the worst storm in 50 years would yield losses of about $22 billion. We had the worst storm you could imagine in 50 years. To give you an example, the worst storm we've had in the last 50 years, from a loss standpoint, was Hurricane Wilma. And the financial losses were just a shade over $10 billion for Hurricane Wilma. It was the most costly storm, believe it or not. Well,
And if I can interrupt
Sure,
you, I want
please.
to tell them why, because of the location of the storm. That's the key. You know, it all goes into where the storm hits, and that happened to be Fort Lauderdale, Miami area. I didn't want it to.
No, that's
important to know why. You know, where you think of Wilma may not have been like an Ivan or whatever that had more, you know, like the structural damage or the wind surge, I mean the water surge, whatever. But I just wanted to to mention that it's important where these storms hit, that the risk that the insurers of the state will incur. Sorry.
no, absolutely. That's a critical point. Well, what the House is, and Ray can correct me if I'm wrong, what the House is saying is, you know, let's add the catastrophe fund that exists now is triggered at $6 billion. When insurance losses hit $6 billion, then insurers can tap in to the CAT fund. The CAT fund is not a welfare fund. Instead, insurers pay to participate in the CAT fund, and they participate on a ratio of the amount of insurance that they write. But they pay. Well, then, of course, what they do is they turn around and pass those costs to you and me. And right now it triggers in at $6 billion. And I think what the House is saying is, well, let's drop that to $2 billion. And you can imagine that that's an area that, you know, it's almost like a deductible. That's an area that's very significant. If you drop the CAT fund trigger to about $2 billion, you're going to pick up a tremendous amount of loss. And consequently, you're going to make it easier for insurers and reinsurers to say Florida is not as risky a place to do business. Here's what the Senate's saying. And it's not a difference of opinion. We're actually coming at it from two different points of view, and I think we'll arrive at these are not disagreements, these are tactical approaches. The Senate's saying, well, let's look at the top. Right now, the top of the CAT fund is $22 billion. Beyond that, the Allstates and the State Farms have to go to the Lloyds of London and the guys in Bermuda and Tokyo and Singapore and Hong Kong, and they have to insure above $22 billion. Well, that's the 1 in 100 year storm.